Silver opened 2026 near $70, ripped to $121, collapsed to $76, bounced to $89, and dumped again, all within days. Normal distribution math says that's impossible. A 39% single-day crash sounds like catastrophe because the financial system trained you to fear volatility instead of understand it. In silver, that fear is misplaced. Silver is not a polite asset. It never has been. It is thin, violent, reflexive, and brutally honest. When leverage builds, when positioning crowds, when paper claims multiply faster than physical metal, silver doesn't correct gently. It snaps. What looks like disaster to the untrained eye is often just pressure releasing. Silver doesn't whisper warnings, it screams them. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And drop a comment below. What time is it where you are right now, and where are you watching from? I love seeing how global this community is. Leave your location and local time, and I'll catch you in the next one. History proves this over and over. In every major silver bull market, the largest gains were preceded by savage collapses. In the 1970s, silver dropped more than 45% multiple times on its way to its all-time high. In 2008, silver was cut in half, obliterated, before rising nearly 500% in the following years. These weren't failures, they were clearing events. Weak hands were forced out. Leverage was purged, liquidity was reset, only then could price discovery resume. The mistake modern investors make is assuming linear progress in a non-linear asset. Silver does not move like stocks. It moves like stress. The reason a 39% crash feels impossible is because most financial models are built on a lie, that markets behave normally. They don't, especially silver. Silver exists at the intersection of monetary fear and industrial necessity. It is traded with extreme leverage, thin inventories, and enormous derivative exposure. That combination creates a market where price is not set by calm valuation, but by margin mechanics. When volatility spikes, margins rise. When margins rise, forced selling begins. And when forced selling begins, price no longer reflects value. It reflects survival. This is where emotion replaces analysis. Panic enters the room. Headlines scream, collapse. Commentators declare the bull market dead. But professionals know better. They recognize this moment as maximum stress. This is when positions are closed, not because they are wrong, but because they are unsustainable under new margin requirements. This is not selling driven by belief. This is selling driven by obligation. The market is not voting. It is liquidating. And liquidation always exaggerates moves beyond reason. Silver's volatility is not a flaw, it is a filter. It exists to punish leverage and reward conviction. It separates tourists from participants. It destroys timing-based strategies and exposes weak balance sheets. When a 39% drop occurs in a market with structural deficits, rising industrial demand, and tightening supply, the correct question is not what broke. The correct question is who was forced out, because price collapses of this magnitude do not happen in healthy under-owned markets. They happen when positioning becomes crowded and leverage becomes reckless. This is why calling a 39% crash abnormal is a misunderstanding of the asset itself. In silver, extreme moves are not anomalies. They are rites of passage. They are the toll paid before repricing. They are the storm before recalibration. Silver does not drift higher on optimism. It explodes higher after despair. And despair only arrives after volatility has done its job, after fear has peaked, after confidence has shattered, after the narrative has turned toxic. So when silver collapses in a single day, the experienced eye does not flinch. It zooms out. It looks at positioning. It looks at leverage. It looks at physical flow versus paper flow. And more often than not, it recognizes the same pattern repeating, a market shaking itself violently to survive. This is not silver in trouble. This is silver doing what it has always done when it is preparing for something much bigger. Wall Street's greatest mistake with silver is not emotional. It is mathematical. For more than 60 years, the financial system has priced risk using a framework that simply does not describe reality. The bell curve, the normal distribution, the comforting illusion that extreme events are rare, contained, and statistically irrelevant. Silver exposes that lie with surgical cruelty. It doesn't just violate the model, it humiliates it. In the 1960s, mathematician Benoit Mandelbrot made a discovery that should have rewritten finance forever. Markets do not move in smooth, predictable waves. They move in clusters of chaos. Extreme moves happen far more frequently than traditional models allow. The tails are not thin, they are fat, and when those tails wag, they dominate everything. Wall Street acknowledged the research, nodded politely, and then ignored it. Why? Because accepting fat tails means admitting that risk is uncontrollable, leverage is lethal, and once-in-a-century events happen every decade. Silver lives permanently inside those fat tails. It is not an asset governed by equilibrium, it is governed by stress. When volatility erupts, it doesn't mean something went wrong. It means the system is revealing what was always there. Hidden leverage, compressed risk, artificial calm. Silver doesn't create instability, it reveals it. That is why its moves feel shocking to those trained on Gaussian assumptions. The model says, this shouldn't happen. Reality says it happens all the time. Normal distribution math tells you that a move like silver's recent behavior should occur once in millions of years. Fat tail math tells you it should occur regularly in leveraged markets. That difference is everything. One worldview breeds complacency. The other breeds survival. When traders price silver using volatility assumptions borrowed from equities or bonds, they dramatically underprice risk. That mispricing builds leverage. Leverage builds fragility. And fragility eventually detonates. The explosion is not the anomaly. The calm before it was. This is why silver's price action feels violent, but is actually honest. It does not smooth over imbalances. It does not respect narratives. It does not care about consensus. When pressure builds, silver releases it all at once. That release looks like chaos, but it is actually a reset. The system sheds bad positions, bad math, and bad assumptions in one brutal motion. And then, only then, can it rebuild on firmer ground. Wall Street hates this behavior because it cannot be controlled with spreadsheets. Risk managers cannot hedge what they refuse to model. Value at risk collapses precisely when it is needed most. Stop losses fail. Liquidity vanishes. And suddenly, everyone realizes they were all using the same flawed playbook. Silver becomes the mirror that shows the industry its own blind spots. That is why it is dismissed, mocked, and misunderstood until it moves. The emotional response to fat tail events is always the same. Disbelief, then panic, then narrative reconstruction. This time is different. Something broke. The market is irrational. But fat tail theory says the opposite. The market is behaving exactly as designed under leverage and constraint. The irrationality lies in assuming stability where none exists. Silver doesn't break models. It exposes the arrogance of using them. When you understand fat tails, silver's behavior stops being frightening and starts being predictive. Extreme volatility becomes a signal, not a warning. It tells you stress is peaking. It tells you leverage is being purged. It tells you weak hands are being forced out. And historically, those moments have not marked the end of silver moves. They have marked the beginning of repricing. So the 60-year-old discovery Wall Street ignored is not academic trivia. It is the key to understanding why silver looks unhinged right before it becomes unstoppable. Normal math calls this impossible. Fat tail math calls it inevitable. And silver, once again, is simply reminding the world which one is real. This was not a panic. It was not fear. It was not a sudden loss of faith in silver. What happened was far colder, far more mechanical, and far more dangerous. The system pulled a lever. When the CME raised margin requirements, the outcome was already decided. Price was going down, not because fundamentals changed, but because math demanded blood. The moment margin requirements rise, leveraged players face a binary choice. Post more capital immediately or liquidate immediately. There is no debate, no discretion, no long-term conviction. Futures markets do not care what you believe. They care what you can fund. And silver is one of the most heavily leveraged markets on Earth. When margins rise in a leveraged market, selling is not optional. It is mandatory. This is the part retail investors and commentators consistently misunderstand. Margin hikes do not cool speculation. They force liquidation. The largest sellers during these events are not weak-handed retail traders. They are funds, desks, systematic strategies, CTAs, risk parity models. These players don't wake up and decide silver is bearish. Their systems simply receive a signal. Margin requirement changed, volatility spiked, capital efficiency collapsed, positions must be reduced now. That is how billions of dollars in paper exposure vanish in hours. Not slowly, not thoughtfully, violently. Algorithms dump contracts into thin liquidity, stops cascade, volatility feeds on itself. Price drops trigger more margin stress, which triggers more selling, which triggers more price drops. This is a self-reinforcing loop, and once it starts, it does not stop until enough leverage has been destroyed. The authority that flips that first domino is the Chicago Mercantile Exchange. The CME does not care about price direction. It cares about systemic risk. When volatility explodes, it raises margins to protect clearing members. That action is rational from a risk management perspective, but catastrophic for anyone running leverage near the edge. The CME doesn't cause the crash. It exposes how unstable the structure already was. This is why silver collapses faster than it rises. Upside builds slowly as leverage accumulates quietly. Downside arrives suddenly when that leverage is called due. The selling you see is not a change in opinion. It is a margin clerk tapping the shoulder of the market and saying, pay up or get out. Most can't pay, so they get out at any price. And here's the critical insight. Forced liquidation has nothing to do with value. During these events, price becomes meaningless. It no longer reflects supply, demand, scarcity, or future expectations. It reflects only one thing: how much paper exposure must be erased to restore margin stability. This is why crashes feel irrational. They are not driven by thought. They are driven by constraints. The emotional violence of these moves is precisely what makes them effective. Confidence shatters, narratives collapse, late buyers capitulate, media declares the trade dead. And all the while, the strongest hands, the ones with capital, patience, and no leverage, watch quietly as paper is flushed from the system. Margin hikes do the dirty work for them. They always have. This is also why these events cluster at the most inconvenient moments. Just when silver looks unstoppable, just when momentum feels obvious, just when positioning is crowded, that is when margin sensitivity is highest. That is when the market is most fragile, and that is when a single policy adjustment can detonate an entire positioning structure. So when you hear CME margin hikes, do not think regulation, think gravity, think of leverage being yanked back to reality, think of a market forced to breathe out after holding its breath for too long. These crashes are not signs of failure. They are purges, and history shows that once the purge is complete, what remains is a market far more dangerous on the upside than anyone expects. This wasn't silver breaking. This was leverage being executed. What happened next is the moment the entire paper narrative fell apart. While silver prices were collapsing on Western futures exchanges, something far more important was happening quietly on the other side of the world. In Shanghai, physical silver premiums exploded upward, not drifted, not stabilized, surged. This is the split second where informed capital stops listening to screens and starts watching flows. Paper was screaming panic. Physical was screaming shortage. And those two signals never diverge unless price discovery is broken. This is the dirty secret of the silver market. Futures prices do not represent metal. They represent claims. And when stress hits, those claims are dumped faster than the metal can ever move. Futures traders sell contracts because they must. Physical buyers buy metal because they need it. These are two entirely different motivations colliding in the same moment. When paper collapses but physical premiums rise, it means one thing and one thing only: the market is lying to you. In Shanghai, silver is not treated as a speculative toy. It is treated as an industrial input, a strategic material, a real asset with real delivery constraints. When prices fell on comex, Chinese buyers didn't panic. They accelerated. They saw discounted paper prices and immediately demanded physical supply. But supply didn't magically appear. Refiners didn't double output overnight. Inventories didn't suddenly refill. Instead, premiums rose because availability tightened exactly when demand intensified. This is where the Western narrative completely breaks. If silver were truly collapsing, physical premiums would fall with it. Dealers would be desperate to move inventory. Buyers would step back. Instead, the opposite happened. Physical silver became harder to source. The price you had to pay above spot increased. That is not bearish behavior. That is stress behavior. That is what happens when futures markets decouple from reality. The epicenter of this signal sits inside the Shanghai Futures Exchange ecosystem, where physical settlement matters more than financial engineering. When Shanghai premiums rise during a paper crash, it means futures traders are selling something they do not possess to buyers who do not care about leverage, narratives, or margin calls. They care about metal in hand, and they are willing to pay more to get it. This divergence exposes the fundamental flaw in paper pricing. Futures markets are optimized for liquidity, not truth. They allow massive volumes of silver to trade without any requirement that the metal exist. In calm periods, that illusion holds. In stress periods, it fractures. The moment leverage unwinds, futures prices can collapse even as real-world demand intensifies. That is not a contradiction. It is a warning. This is why professionals watch premiums, not headlines. Premiums tell you where the metal is going, not where the contracts are going. When premiums rise, it means supply is constrained relative to demand. And when that happens during a price crash, it tells you the crash is artificial, driven by paper mechanics, not by real selling of metal. The futures market is evacuating risk. The physical market is accumulating scarcity. Emotionally, this is the point where most investors get it wrong. They see price falling and assume value is disappearing. In reality, value is migrating from paper to physical, from weak hands to strong hands, from leveraged balance sheets to cash buyers. The metal isn't being rejected, it's being repriced into stronger ownership. This paper-physical divergence has appeared before, and every time it has marked a turning point. Not immediately, not gently, but decisively. Futures markets can push prices down temporarily. They cannot create silver. They cannot deliver what doesn't exist. Eventually, price must reconcile with availability. And premiums are the early warning system screaming that reconciliation is coming. So when you see paper silver crash while Shanghai premiums surge, do not call it weakness. Call it what it is, a structural stress signal. A market tearing itself in two. One side drowning in contracts, the other scrambling for metal. And history is very clear about which side wins when that gap finally closes. The most dangerous lie in any market is the idea that a deficit can vanish just because the price falls. Silver's didn't. The world is still short roughly 820 million ounces, and that shortage didn't magically heal because futures traders panicked. Mines did not suddenly produce more. Scrap flows did not surge. Industrial demand did not pause. The deficit is structural, embedded, and stubborn, and price volatility does nothing to change physical reality. Silver is consumed, not hoarded. It disappears into solar panels, electronics, medical devices, defense systems, and energy infrastructure. Once used, much of it is gone forever. This is not gold, sitting quietly in vaults waiting to be sold. Silver is burned, scattered, and locked into products that cannot be economically recycled at scale. That reality creates a supply curve that is inelastic, slow to respond, slow to grow, and painfully vulnerable to shocks. And the shock is already here. Years of underinvestment have hollowed out the mining pipeline. New silver supply takes a decade to develop, and most silver is produced as a byproduct of other metals. That means higher prices do not instantly bring more silver to market. They simply expose how tight things already are. The deficit is not a forecast. It is the result of years of neglect colliding with exploding demand. Now add geopolitics. China's new export restrictions are not symbolic, they are strategic. Less refined material leaves the country, more stays domestic. Global supply tightens at the margins exactly when Western inventories are thin and futures markets are unstable. This is how localized policy decisions ripple into global scarcity. The silver market is small. It does not take much friction to throw it completely off balance. Here is the key point professionals understand. Deficits express themselves through volatility before they express themselves through price. The market doesn't move smoothly higher to reflect scarcity. It lashes out, it spikes, it crashes, it destabilizes paper structures until supply and demand are forced back into alignment. The deficit didn't disappear. It started exerting pressure. This is why violent price action is not a contradiction of the shortage narrative. It is confirmation of it. When a market is truly oversupplied, price falls and stays quiet. When a market is undersupplied, price becomes unstable. It swings because the system is struggling to ration limited material across competing uses. That struggle shows up first as chaos. So when you hear that silver collapsed, remember this. The metal didn't change. The shortage didn't change. The deficit didn't change. What changed was the paper illusion that price could ignore scarcity forever. And once that illusion cracks, the adjustment is never calm. This is the moment where most people lose the plot. Volatility explodes, confidence collapses, and the crowd assumes the thesis is broken. But history tells a very different story. Every major precious metals bull market required this exact kind of violence, not as a side effect, but as a prerequisite. Gold and silver do not enter parabolic phases on optimism. They enter them after disbelief, after exhaustion, after positioning has been ripped apart. Professional capital understands this. That's why long-term targets don't disappear during chaos. They harden. When institutions model extreme outcomes like $6,300 gold or $150 silver, they are not forecasting smooth trajectories. They are acknowledging a regime shift, a world where debt, geopolitics, and supply constraints collide in nonlinear ways. These outcomes are not reached by steady accumulation. They are reached through repricing events, and repricing events are always preceded by destabilization. This is where the fat tail framework becomes the only lens that matters. Fat tail markets do not reward patience alone. They reward survivability. They punish leverage, complacency, and false precision. In these markets, the average outcome is irrelevant. What matters are the extremes. The tails dominate returns, and silver lives permanently in those tails. Long periods of frustration are punctuated by short, explosive moves that erase years of gains or losses in weeks. Volatility is not the enemy in this framework. It is the signal. It tells you stress is peaking. It tells you the distribution is shifting. It tells you probability is no longer centered. It is stretching. When silver becomes untradeable, unhedgeable, and emotionally unbearable, it is often closest to its most asymmetric upside. This is the phase where narratives turn toxic and conviction becomes scarce. That scarcity of belief is fuel. The mistake is thinking targets are predictions. They are boundary conditions. They define what is possible when systems break and capital repositions. In a fat tail world, price does not drift toward these levels. It jumps toward them after pressure has been fully released. That release is what you are watching now. The market is shedding leverage, flushing weak hands, and resetting its base. This is why volatility clusters at turning points. Calm is not strength. Calm is compression. And compression eventually snaps. The snap feels like failure. In reality, it is transition. From paper dominance to physical constraint, from speculation to necessity, from disbelief to revaluation. So when silver looks unhinged, remember this. Fat tail markets only look chaotic until they suddenly don't. And when the move finally comes, it doesn't ask for permission.